Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving the FM pre-June mock. So it's going to be a series of videos where I solve the mock in parts. The first video is going to be the entire section A. The second video is going to be, your section B essentially has 3 OT case studies. So I'm going to put one video for each case study. So 3 videos for your section B questions. And then the 2 questions that you have in section C, I'm going to have 2 separate videos for those 2 questions. So this is how I'm going to divide, the debrief of this mock so that it becomes easier for you to navigate through whichever question you have a doubt in. You can straight away head to that. So without any further ado, let's get started with the section A. I'm going to solve the entire 15 marks of the 15 objective test questions which are there in section A over here. So the number 1 question, let's read. In relation to an irredeemable security paying a fixed rate of interest, which of the following statements is correct? Now, please pay attention to the fact that I have highlighted over here which statement you have to identify is correct. Be mindful that in your exam, the examiner can also ask you to identify the incorrect statements. So make sure you're clear at the back of your mind what exactly is the requirement. Are you supposed to identify the correct statements or are you supposed to identify the incorrect ones? So let us move towards the statements and see which one is correct. As risk rises, the market value of a security will rise to ensure that investors received an increased yield. Now, break down the statement. Your risk has risen. So the statement is saying market value should rise so that investors received an increased yield. This statement is not correct. And why is that? Because when your risk is rising, investor definitely needs to be compensated for the increased risk in the form of increased return. So this is for sure that investors need to receive an increased return. But increased return will only be there if your market value of the security actually falls, because you're only paying a fixed interest on this security. So the percentage of interest will be higher if the return basically is the interest that the investor is getting. So the percentage of the return will be higher if the market value is a lower amount. That is why statement 1 is incorrect. Moving to statement 2, the market value of an irredeemable loan note is calculated by multiplying the interest by 1 minus the tax rate and then dividing by the yield of the loan note. This is incorrect. You only take the 1 minus tax rate aspect when you're calculating the cost of this instrument from the perspective of the company. Market value is always calculated from the perspective of the investors. It is not the investors who get the tax benefit on debt. It is the company who gets the tax benefit. So statement 2 is also incorrect. Now coming to statement 3, irredeemable loan notes are a tax efficient way of raising finance. This is absolutely correct because the interest that a company pays on loan notes, because this is a debt, this gets subtracted, the interest on debt gets subtracted before arriving at the profit at which tax is levied. So because the interest that the company is paying on these loan notes gets subtracted before the profit is arrived, the profit is a reduced figure, hence it helps the company to reduce the amount of tax liability that they have. So statement 3 over here is the correct answer. Moving ahead to the second one. Corpus Company is an all-equity financed company which is considering an appraisal of a project in a new area of business. Its existing equity beta is 1.3. The equity beta for Christie Company, a company in the new business area, is 1.5 with a debt divided by debt plus equity ratio of 35%. The risk-free rate of return is 4% and the market risk premium is 5%. So you have to ignore taxation, use the CAPM to calculate the risk-adjusted cost of equity for the new project to 1 decimal place. So basically, this Corpus Company does not have, any debt. So it's all equity financed. Basically, existing beta is given to you. And the new area in which it is entering, they have identified a proxy company, which is Christie Company. And the equity beta for the same is also given. You have the debt divided by debt plus equity ratio also given to you. And then the risk-free rate of return and premium are given. This will help you to calculate the cost of equity using the CAPM model. So I've opened a small Excel sheet over here, which will help me to show you how I perform the calculations. So the number one step that we have to do over here is that we need to ungear the equity beta of Christie company. So ungearing equity beta of Christie company. Now, number one thing, we are given with the equity beta, but you have the debt is to debt plus equity ratio. Now, you know that debt divided by total of debt plus equity is 35. So now you need to find out what is the proportion of equity, because in the formula, you need both value of debt as well as value of equity. So over here, because we are ignoring taxation, if you see value of debt divided by value of equity plus value of debt, this figure is given to you as 35%, right? This is 35%. So therefore, if you take value of equity in the numerator, equity is going to be value of equity plus value of debt. This value is going to give you 65%. Simple, if debt is 35, then equity is going to be 65. This is how you arrive at the proportions which are there for debt and equity. Now, the next thing that we do, we find out the asset beta. How will we find out the asset beta? You also have this formula in the formula sheet. So if I just show it to you, this is your FM formula sheet. You will have all of these formulae in the exam also. This is the asset beta formula. So I can keep this open so that it gives you a better context. The equity, how much is the equity beta given? Equity beta is given to be 1.5. So again, let's open the formula sheet as well. So 1.5 needs to be multiplied with value of equity. First, I'm taking the value of equity. Value of equity is 65%. So 65% divided by value of equity multiplied by the beta equity, which is given as 1.5. So with this, you arrive at your asset beta, which is 0.975. Now, the next thing that you're supposed to do is that you need to re-gear it according to the capital structure of corpus company. But if you see, corpus company is all equity financed. This means they do not have any equity beta. Their equity beta is going to be the same as the asset beta, because asset beta is representing the business risk, and then your equity beta represents business as well as financial risk. Now, because corpus company does not have any debt in their capital structure, that is why they do not have any financial risk. So their asset beta is also equal to their equity beta. So I'm going to be using the same beta as the equity beta equals to this value. And then simply I can use the CAPM formula. CAPM formula is nothing but you take first of all the risk-free rate. So risk-free rate is 4% plus RM minus RF, which is the market risk premium, is already given to you as 5%. Please do not make the mistake of subtracting 5 minus 4 and then taking the value. And then you multiply this with your equity beta. With this, you will arrive at 8.875, which basically translates to 8.9%. So this is how you answer this question. Moving ahead, all right. So the following are the extracts of the financial statements of Simply Company. This is the revenue, this is the cost of sales, inventory, trade receivables, payables. Purchases for the year have totaled to $1,251 million. Assume a 360-day year. Calculate Simply Company's inventory holding period, trade receivable collection period, and trade payables payment period. All calculations should be to the nearest day. So basically, whatever calculation you do when you get your answer, you need to drag these things and put it to here so that the examiner is going to mark you. Obviously, we all know section A and B are all computer marked, so there's no human involvement. That is why it's very essential that you follow the rounding off instructions. It is mentioned all calculations should be to the nearest day. So if you're getting 38.5, so then you'll make it 39 days. That is how we work in rounding off. Now let us move to this question. The first thing that I need to calculate is my inventory holding period. So to calculate the inventory holding period, let us use the formula which we have learned. It's nothing but your inventories divided by your cost of sales multiplied by 360, because they have told us to assume a 360-day year. So my inventories over here are 345. I divide that by my cost of sales, which is 2150. So this is the ratio, and then I can just simply multiply this by 360 because this has been given to me as the instruction. So this is 57.76, roughly translates to 58 days. So I drag this over here. Then let's talk about the second aspect, which is the trade receivables collection. So if you see trade receivables, you have 455, 85% of your sales are on credit. That means the receivables are actually representing 85% of your sales. Now, because in your denominator, you're going to need how much your total credit sales are. That is why this information has been provided to you. So revenue you have already been given. Now, out of this, credit revenue is 80%. So my numerator is going to be my trade receivables, which is 455. I divide this by my credit revenue. So the sales which I've done on credit. So my total sales are 3560, and out of that 85% of my sales are on credit. So this is how I arrive at the percentage. And then if I want to have the number of days, simply multiply by 360, and this gives me 54 days. So I pick the option of 54 and I put it over here. Now let us move towards the trade payables. Trade payables are given to you readily. So the formula that we have, you take the trade payables and then you divide your trade payables by the purchases. So your purchases are 1251. These are the amount of your purchases. You multiply this by 360, and with this you have your answer as 63 days. So I pick 63 and put it over here. This is how you answer drag and drop questions. Moving ahead to the next question, this is question number 4. Which of the following statements is or are true? So let us read statements one by one and we'll see which of them is true. The sensitivity of NPV to a change in sales volume can be calculated as the NPV divided by the present value of the future sales contribution after tax. This is absolutely correct. For sales volume, you use contribution, and for the selling price sensitivity, you use the revenue. So statement 1 is for sure correct. That means option 2 and option 3 get eliminated. It's either this option or this option. Let us move ahead. The problem with risk and uncertainty in investment appraisal is that it can neither be quantified or measured. So this is incorrect. With risk, it's actually possible to quantify or measure with the help of probabilities. So that is why statement 2 over here is incorrect. The lower the sensitivity margin, the less critical the variable is to the NPV decision. This is absolutely wrong. If you have studied your fundamental concepts, you would know the lower the sensitivity, the higher, the more critical it is to the value to your NPV decision. So if it is less, the lesser the percentage, let's suppose the sensitivity to maybe sales volume is 5%. So this is a very less, figure. So if my sales volume gets down by 5%, then my NPV can straight away come to 0. So a lesser change in, my sales volume is going to have a big impact. That is what this means. So statement 3 is also incorrect, which leads us to option A as our answer. It's only the statement 1 is correct. Moving ahead, which of the following is an illustration of the principal agent problem? So let's read. Suppliers cutting their costs by using cheaper materials to keep their prices low, not really. Managers avoiding debt finance because lower interest payments avoids the need for careful cash management. This is absolutely correct. what happens is basically the agent over here is nothing but the managers or the directors who run the company, and the principal basically over here are your shareholders. So the shareholders obviously want that debt should be used in the form that it reduces the tax liabilities, it gives benefit to the shareholders. So any managers who are avoiding debt finance because they think that lower interest payments avoids the need for careful cash management, this is definitely one behavior, dysfunctional behavior, which they are displaying due to this entire principal agency relationship. Then shareholder groups disagreeing over dividend policy. There is no principal agent relationship over here. Stock market exerting pressure on companies to achieve short-term profits. This is also no relation of a principal agent. So the second option over here is your answer. Moving ahead to the sixth question, a machine costing $225,000 has a useful life of 4 years, at the end of which end of which time its estimated present value of resale will be 15,300. So they've already given you the present value of the resale. You do not need to discount this. This has already been discounted. This is the present value. The present value of the total running costs over the next 4 years is 55,567. So basically they have given you the present value of the cost also, and they have given you the present value of the resale as well. And you have the initial cost also, which goes out in year 0. They want you to find out the equivalent annual cost of using the machine if it were bought and replaced every 4 years in perpetuity to the nearest dollar. The company's cost of capital is also given to you as 10%. So now we come back to our Excel. This question involves numbers. Firstly, we need to find out the NPV. So how do we find out the NPV? Number thing is our initial outlay. Initial outlay will be presented as a negative figure because this represents money going out of our business. So minus 225,000. Then you have running costs throughout the entire life. Running costs are given to you. Again, this I am putting as a negative figure because this represents your cash outflows. And then you have an inflow, which is going to be the resale value. So resale is going to give you an inflow of 15,300. So you sum all of these up. This will give you your net present value. This is the net cost which will be there to the company if they are using this machine. Now, to calculate your annual equivalent cost, you essentially need to find out the annuity factor, and you divide this value by that annuity factor, and you will have your annual equivalent cost. So let us go to the formula sheet where you have the tables. Moving to the annuity table, in your annuity table, 10% is the cost of capital which has been provided. So I immediately turn to 10%. Over here, my period is 4 years. So 10%, 4 years, you find the annuity factor as 3.170. So this figure needs to be divided by 3.170. So with this, you arrive at your answer as 83,680.4. Because they want you to round it off to the nearest dollar, I'm going to write my answer as 83680. So it's 83680. 680. This is what I enter in my answer. No decimal places. Even if you try to put in, it's not going to allow you. So this is how you answer this one. Moving ahead to question number 7, Connolly Company has 75 million equity shares in issue and has just reported a profit after tax of $35 million. A new issue of 25 million equity shares at an issue price of this much is being considered. All the proceeds would be used to redeem a bank loan with an annual cost of 5%. Connolly Companies pays corporation tax at the rate of 25%. Assume that the operating profit, which is nothing but your PBIT, that this remains constant. If the equity issue goes ahead and the bank loan is redeemed, what will be the new earnings per share. So basically, you have all of the information given to you. The loan notes, the bank loan is going to be redeemed. So there's no interest that is going to be charged over that. So now you have to find out how much will be your new EPS. Now, because you're issuing new equity shares, your number of shares are going to rise. So let us do the calculations over here. Let us see what is going to be your new earnings. So PBIT is given to you as how much over here? It's 35. So this has, the profit after tax is given to you as 35. PAT is given to you as $35 million. Now this is after they have subtracted the tax and after they have subtracted the interest also. So firstly, I need to find out how much was the tax. Then I will arrive at profit before tax. Then I will arrive at the interest. And then I will arrive at the PBIT, which is profit before interest and tax. So over here, we are going towards a reverse working. So tax would have been 25% of this value, profit before tax. So if my PAT is 35, how much is going to be my PBT? It's nothing but whatever was my PBT, 75% of that is 35. So my PBT is nothing but this multiplied by 100 divided by 75. So my PBT would have been this much. Then I would have applied a tax of 25% on this value. So if you just see this, 46 minus 11 would have given you your profit after tax of 35. So this is how I worked out PBT and tax. Now, if you talk about interest, interest is already given. There was a bank loan which had an annual cost of 5%. So how much would have my interest been? My interest would have been, so I am issuing 25 million equity shares at an issue price of 1.2. So to find out how much is my bank loan worth, 25 multiplied by 1.2. This is the value of my bank loan, and on this I used to pay 5% interest. So equals to this value over here multiplied by 5%. So my profit before interest and tax would have been this plus this. So with this I have arrived to my PBIT. Now this, as it is mentioned in the question, PBIT is expected to remain constant. Now, when I talk about the PBIT for this year, PBIT, it's going to remain the same. This is my PBIT. Now, I do not have any interest, so I straight away, I can call it that this is my PBT, profit before tax. Now, I pay 25% of tax on this equals to 25% on this. So the difference that I get is nothing but my profit after tax. So 36.125 is my profit after tax. Now I need to arrive at the number of shares. So basically earlier I had 75 million. Now I have 25 million more. So total number of shares that I have with me at the moment are 100 million. So I need to divide this. EPS is nothing but your profit after tax divided by your number of shares. Number of shares are 100 million. So it gives you 0.36125. So this is the closest answer, 0.361. Moving ahead to question number 8, which two of the following descriptions are not main macroeconomic policy objectives? Please lay emphasis to the word not. You have to find out which is not a macroeconomic policy objective. Let's read the statements one by one. Ensuring minimum amounts of price increases, this is an objective, hence will not be your answer. Increasing national income and living standards, again is an objective, so not your answer. Ensuring a balanced ratio of imports to exports, again is something which is an objective of the government. Then maintaining interest rates at minimum levels, this is not what an objective is. The rates, the interest rates will be maintained at a point which is optimum for the economy. The macroeconomic policy has objectives. So to meet those objectives, whatever interest rates are required, the government is going to keep those interest rates. Then balancing government spending with tax receipts. Again, this is not an objective. The government may even run into a a deficit if it is needed to ensure the proper condition of the economy, and may even run into surplus if they want to curb inflation. Then ensuring a fully stable and employed labor force again is an objective, hence will not be your answer. Moving ahead to question number 9 now. Biha is a listed company seeking new sources of finance to fund a long-term investment project. The directors have been advised that Islamic finance is alternative source to conventional finance. Which of the following statements in relation to Islamic finance are correct? So let us read the statements one by one and we'll see which of them are correct. Mudaraba is a form of equity where profits are shared according to a pre-agreed contract and losses solely attributable to the provider of capital. This is absolutely correct. This is what we have studied about the concept of Mudaraba. Let's move to Musharaka. Musharaka is a form of equity finance in which investment partners receive dividends and losses are shared according to capital contribution. This is not correct. Basically, Islamic instruments will never pay you dividend. They only share profits. There's no dividend, there's no interest, only profit sharing. So statement 2 is incorrect. Sukuk cannot bear interest. The Sukuk holder's return for providing finance is a share of the income generated by the bonds. This is also absolutely correct. Like we have studied in the principles of Islamic finance, that interest is not allowed in Islam. Hence, Sukuk can never bear interest. So far we have found statement 1 and statement 3 to be correct. Statement 2 is incorrect. So any option that involves statement 2 should get eliminated. This option goes away, this option goes away, this option goes away. So you're only left with 1 and 3. Let us see if fourth statement is correct or not. Islamic instruments by their nature mean that they are not traded through a secondary market. Now this statement is also incorrect. It does not mean so. Islamic instruments are basically the instruments which are there so that they follow all of the principles of the Sharia law in Islam. It is not necessary that they will not be traded on a secondary market. Hence, this statement is also incorrect. So 1 and 3 is your answer. Moving ahead to question number 10 now. A large listed company is to issue 90-day commercial paper with a nominal value of $5 million. Each paper will have a nominal value of $10,000. The annual required rate of return is 6%, assuming a 360-day year. What will be the issue price of each paper? So basically, you have the return given to you, you have the duration given with you, you have your nominal values, and you have the nominal value of each paper also. So basically, you just need to find out the issue price over here. It's nothing but we're going to take the nominal value. Take the nominal value 10,000, multiply this by 1 upon your yield. So basically, yield that you have is 1 plus 6% is your required rate of return, and this is for a 90-day period when it comes to. So basically 6% is given to you as annual, but you need to account for the fact that this is only a 90-day commercial paper. So 6% into 90 by 360 is what you will have to do over here. Into 1 plus 6% multiplied by 90 by 360. So you close all of your brackets, hit enter, and you will have your answer. Let us work out separate calculations. 10,000 is what the nominal value looks like. Then if you adjust for your interest, it is 6% equals 6% multiplied by 90 divided by 360. So this gives you 0.015 as your cost of capital basically. So this divided by 1 plus this value over here, you hit enter and you will get 9582. So sorry, 9852, and in the nearest sense it will lead you to an answer of 9850. This is the closest option that we have available. All right. So let us move ahead. Question number 11. Financial extracts from Salvo company. You have the revenue, you have the PBIT, profit after tax. You need to find out the interest cover. It is pretty simple. You just take your PBIT and divide that by your interest payments. So let us see how much is our interest payment over here. Interest payment is going to be nothing but on these 8% loan notes. So 8% of 3525. So this is how you arrive at your interest, which will come out to be 282,000. Now interest needs to be divided by your PBIT. So PBIT is also given to you, which is 2650. So interest cover is nothing but PBIT upon interest. So this divided by this over here, you have your answer as 9.39 times. Now, because they want only one decimal place, so I'm going to round it up to 9.4 times. So 9.4. Moving ahead, this is question number 12. Bar company has set an inventory ordering quantity of 100,000 units. The cost of placing and processing an order is $200, while the inventory holding cost is 50 cents per unit per year. Orders are received 1 week after being placed with the supplier, so a buffer inventory of 10,000 units is required. The production requirement for the next year is given to you as 600,000 units. Now you have to find out the cost of bar company's inventory ordering policy. Always remember, whenever you ask the cost of inventory ordering policy, you're supposed to take two things. Number one, the cost of ordering, and number two, the cost of holding. So these two costs you will individually find out, add them together to get to your final answer. So moving to, first of all, the cost of ordering. So how do you find out the cost of ordering? Firstly, you need the number of orders. Number of orders will be nothing but your annual demand divided by your inventory ordering quantity. So 600,000 divided by 100,000. That means you're going to place 6 orders every year. So your cost of ordering will be cost of placing one order, which is 200, multiplied by the number of orders, which is 6. So you have $1,200 as the cost of ordering. Now over here, let us move towards the holding cost. Holding cost is always applied to your average inventory plus the buffer inventory. So let us calculate the holding cost. Number one, let's find out the units. How much units are we going to be holding? Firstly, it's going to be the average units, which is 100,000 divided by 2 plus the buffer inventory. Buffer inventory is given to you as 10,000. So holding cost on a total is going to be applicable to 60,000 units. Per unit cost is already given to you as 0.5. So 30,000 is what your holding cost is going to look like. Now you have your ordering as well as holding cost. Just add both of these values together and you will have your final answer. 30,000 plus 1,200 gives you 31,200. So you are already answering to the nearest dollar. It's 31200. Moving ahead to question number 13. Question number 13 says, which of the following statements about the over-the-counter interest rate option are correct? So it's an interest rate option and it is OTC. It is customized according to the needs of the person who is entering into this agreement. So let us read the statements one by one. It is an agreement within financial institution. That is absolutely correct. Could be a bank, could be any financial institution, that is for sure. It can be traded. No, it cannot be, because these are over the counter. These are customized, especially for the person who is getting into this agreement. They cannot be traded on the market. So option 2 over here is incorrect. I can mark it with red. Then the option may be traded, may or may not be exercised. This is absolutely correct. Whenever you're entering into a contract, which is an option, it gives you the right, but not the obligation to do something. So hence, you have the option. It is your choice whether you want to exercise this or whether you do not want to exercise it. So far 1 and 3 are what seem correct to us. Let's see, a premium is payable only if it is exercised. This is not correct. Premium, whenever you are getting into an option agreement, premium you're supposed to pay upfront whenever you are buying that option, buying or selling the option. So premium is something that needs to be paid whenever the contract is entered into. And even if you do not exercise the option, the premium is non-refundable. Hence, statement 4 over here also is incorrect. So my answer becomes 1 and 3 only. So option C over here says 1 and 3. So I select that and move ahead. Which of the following statements is or are true? An aggressive working capital policy, capital investment policy implies a higher proportion of fluctuating current assets to permanent current assets. This is absolutely incorrect. The aggressive investment policy will be the one which has a lower amount invested in your working capital. So higher proportion, this itself makes the statement wrong. Moving to the second statement, long-term finance is generally cheaper than short-term finance. This is absolutely incorrect. We have always discussed that whenever you're lending or you're borrowing for the long term, it makes it more risky for the party who's giving you the loan. Hence, they will demand a higher interest rate. Hence, long-term finance is rather generally more expensive than your short-term finance. So, neither 1 nor 2 is correct over here. Moving ahead to the last statement, last question for your section A. An exchange loss of $100,000 is expected to result in the consolidated accounts of Aperol Company after consolidating the results of its foreign subsidiary. So basically what they have done is, Aperol Company has a foreign subsidiary. So to combine all of the results together, to consolidate all of their accounts, they have translated the figures of that foreign subsidiary to their domestic currency, and this has led to an exchange loss of $100,000. So which type of exchange rate risk would Aperol Company experience if with the $100,000 loss in its consolidated financial statements? Like I let you know, this is the loss which has arisen in the translation of the financial statements. So this is nothing but your translation risk. Translation risk is basically the risk that you will get into a gain or a loss from, while you are consolidating the accounts from your foreign subsidiaries or foreign assets. So with this, we are done with section A. In the next video, we are going to start with the first case study of section B, and then we'll move ahead in the sequence that I told you right in the beginning of this video. I hope that this video helped you in understanding the questions which you were not able to understand, and all the very best for your June exams.